I'm Stephen Carroll and this is Here's Why, where we take one news story and explain it in just a few minutes with our experts here at Bloomberg. We've seen three sets of recent elections that have made waves on the markets. In South Africa, India and Mexico, we saw stocks sell off and currencies weaken as the results rolled in, even if they weren't a total surprise.
Volatility coming through in stock market indices where there have been these elections.
The Nifty, the Sensex, yesterday declined 6%. Worst day in 4 years. $390 billion of market cap just wiped out.
Polls missing the mark, and then he lost the majority. That's triggering a slump in markets. And then Mexico as well, with the landslide victory of the ruling party, raising concerns of increased state control.
South Africa's election left the ruling ANC weakened and seeking coalition partners, as polls had been suggesting. India's Narendra Modi lost his majority in parliament, but he'll continue as Prime Minister with the help of his allies. And in Mexico, Claudia Sheinbaum was the clear favourite to become president and was duly elected by a wide margin. So here's why markets tumbled when election favourites won. Joining us to explain is our Markets Live executive editor, Mark Cudmore. Hi, Mark. We're talking here about three very different countries in vastly different parts of the world. But is there a common theme in the market reaction we've seen to these election results?
The amount of volatility shows that there is complacent positioning there. So there is a common theme from the market side. From the election side, as you kind of outlined there, is not really a common theme. One did better than expected, one did worse than expected, one did pretty much in line with the polls' expectation. So the political stories are all very idiosyncratic. And what's really happened is the fundamentals in all these countries haven't really changed from the elections this week. This isn't about a fundamental shift. It was about this kind of story of elections suddenly putting these countries in the news that really blew out complacent positioning, and that triggered a real kind of volatility event, particularly in India and Mexico.
Well, let's turn to Mexico then. The results there perhaps the least surprising. The expected candidate won, and comfortably so. So what's gone on there?
So the backfitted narrative here is that with the chance of a supermajority, maybe they'll start enacting some reforms that are less business friendly, less market friendly. Really, I just don't buy this at all. Like, Mexican pesos just had an incredible run for the last couple of years. And the fundamentals kind of suggested it had run far enough by last month. And basically what you had, one of the main reasons the Mexican peso had done so well is because it was one of the best carry trades in the world. You earn a very high yield for parking your money in Mexican peso, and it was relatively low volatility, straight line appreciation. But the problem is, with the Mexican election that was coming up ahead as of last month, and the fact that we got the US election later on this year, it means implied volatility measures out the curve have risen. And that means the carry to vol ratio, which is what carry traders focus on, has deteriorated for Mexico. So therefore, Mexico, it's not necessarily a bad option for carry traders, but it suddenly went from being clearly one of the best in the world up for the last year or so until last month when it was suddenly like, middle of the pack and not very exciting. And I think that's the real reason the Mexican peso sold off. Suddenly with all that complacent positioning, hadn't realised the fundamentals had changed. Suddenly we've got a narrative putting it in the spotlight, sells off badly, and everyone blames it on the election results, but it's nothing really to do with the election.
Mark, now you're going to have to remind us of what the carry trade is, in case anyone has forgotten all of their fundamental markets training.
Yeah, carry traders, FX traders' favourite, but people use it across all markets. The classic one in FX is you borrow in a currency that offers a low interest rate, a low yielding currency. Or in the last number of years, you've had the opportunity to borrow in countries that pay you to borrow in those currencies. And then you park it in high yielding countries, thereby earning the kind of yield differential. And actually you can perform variations of carry trades across almost any asset. FX is one of the most classic ways to do it. But in reality, any kind of trade which is selling volatility is like a carry trade in some senses. You earn in the time decay is another way of doing a carry trade. And the way carry trades work, whether it's doing it in FX, just selling low yielders, buying high yielders to earn the interest rate differential, or whether it's selling volatility, they all have the same kind of return profile where they have consistently outsized returns for a period, and then they tend to blow up in short notice. So there's a risk event or a catalyst, and everyone blows up. And there's some people who are more negative about carry trades portray them as collecting pennies in front of the bulldozer. I think if you have slightly more sophisticated models, which many funds around the world have, you can actually have very successful carry trades that run over many years because you build in a load of indicators of when to kind of trim your risk before those vol events.
Now I'm just imagining you catching pennies in front of a bulldozer. Anyway, let's turn to the Indian market reaction we saw. Pretty big, biggest sell-off in 4 years for stocks there. But actually, those losses were recovered within a couple of days. So why the excitement there?
Yeah, this is a slightly strange one in terms that relative to Mexico and South Africa's story, this is the one where there has generally been some arguably negative election news in the margin. But it's kind of a weird narrative. It's not massively negative to where we were a week ago. So a week ago, before the final exit polls, we kind of thought that Modi would get a majority. That was kind of the base case. And, he hasn't got his majority. He's going to have to form a coalition. But that doesn't really change much in terms of what he'll be able to do. He wasn't able to enact the major reform he wanted, business-friendly reform, when he had the majority. So the fact that he's got a coalition doesn't really change that narrative. The problem was that on Sunday we got these exit polls which suggested that he might get a supermajority, which would enable him to enact stuff. So what happened is we suddenly got this big rally on Monday based on those polls because it was like, whoa, it's a better outcome than we expected going into the weekend. Tuesday that turned out. Now, the history of Indian exit polls is actually quite flawed, so we should have taken that with a large pinch of salt. We went in on Tuesday, found out the results were much more negative for Modi. And what happened is we didn't just unwind the premium from Monday, we suddenly panicked. And again, it was about complacent positioning. And it goes back to the initial kind of question, what's the common theme here? Volatility and complacent positioning. Indian assets, but particularly Indian stocks, were kind of priced for perfection going into this event. And Monday kind of added a little bit of the cherry on top of perfection. And therefore that got hit and got unwound. I think Indian stocks will have a little bit of a problem making outsized gains from here. Not because the story has turned negative, not because it's a fundamental story, but just they're already priced extremely well and they need the world to stay wonderful making gains. So I don't expect India to continue being outperformers in global stock markets in the second half of this year.
Okay, Mark, does this mean that we just need to be more prepared for this sort of thing to happen in the future?
It's a reminder that traders tend to... Look, we all do this. We kind of fit narratives to events after the fact. And knowing that its stories are sometimes backfitted to what the price action is, sometimes it's a good idea to be extremely attuned to when there might be a catalyst to change the narrative. And that's a reminder that going into these catalysts to look at those fundamentals. So if, last month you kind of looked at like the Mexican carry trade that's been wonderful the last couple of years, you'd have gone, oh, actually the risk reward's pretty poor now because implied volatility's gone up loads. And you would have gone, oh, I better get out of this position. It's the same, I think, with India. You would have gone, oh, okay, stocks are priced like one of the most expensive in the world. They're priced expensive compared to almost every other stock market in the world. They're priced expensive compared to their own history. Yeah, it's a wonderful structural story, but haven't we priced it enough? And I think that's the kind of idea. These bigger news events are prompts that before going into them, you should check your fundamentals are up to date.
And you should read the Markets Live blog. Mark Cudmore, our executive editor for Markets Live, thank you very much for joining us. For more explanations like this from our team of 2,700 journalists and analysts around the world, search for Quick Take on the Bloomberg website or Bloomberg Business app. I'm Stephen Carroll. This is Here's Why. I'll be back next week with more. Thanks for listening.